Well, more economic figures coming through today would show how our economy is trying to recover after the hard lockdowns of last year. How good a job is it doing in getting food into your household? They're good and bad numbers, and of course it also depends on how you look at it. The bad number first. Overall last year, 2020, our economy shrank by 7%. In other words, there was 7% less economic activity in 2020 than there was in 2019. Everything you've heard about the horror story that was 2020 was true. But Statistics SA does have some good news. In the last quarter of last year, after the hard lockdowns, our economy grew by 6.3% on an annualized basis. The reason that's good news is that's generally better than expected. Razia Khan is Chief Economist for Africa and the Middle East at Standard Chartered. So, Razia, good afternoon to you. Well, let's start with the good news. Our economy did appear to bounce back more strongly than expected.
Yes, certainly. The one thing that we can't ignore, even though it is old news in a sense, GDP is always backward-looking, but that was that the performance of the South African economy in the fourth quarter of 2020, a year when we had seen a significant decline overall, as you've mentioned, because of the COVID crisis, at least in the fourth quarter, we saw continued momentum. So to put this in context for everyone, we know that the economy took the worst hit as a result of the COVID containment measures, the lockdown in the second quarter. The third quarter had surprised by being as strong as it was, beating market expectations even then, and we did see a revision even to higher levels of that third quarter data. For the fourth quarter, there was a sense that there might be some degree of normalization. Maybe economic activity remained robust as more lockdown restrictions were lifted, as activity normalized. And what we ended up getting was a pretty decent set of data suggesting that actually there had been more momentum than many economists expected.
Is this about a sort of pent-up demand? You know, if you're running a foundry, well, after a year of lockdown or after 8 months of lockdown, you really do need to get that sort of, furnace fixed. If you're a homeowner, after 8 months of lockdown, you really do need to get that garage door sorted out. Is it about that sort of pent-up demand, or could there be something else to it?
Absolutely, and that's the big concern, because what we saw in South Africa is no different to what we're seeing in a lot of other markets across the world, developed and developing markets alike. And that is, during the lockdown, people can't go anywhere, they can't really spend on very much, essential goods are available, they can spend on food, but not a lot else. So there is, by default, an increase in household savings. And as soon as some of those lockdown restrictions are relaxed, you get consumers going out and spending. But the problem with that kind of data is it's very difficult to say this is going to be sustained. It could just be a feature of that mini consumer boom that happens as lockdowns end. And indeed, for South Africa, the real test is going to come over the coming quarters. We already know economists are anticipating that because of the second wave of COVID, we had started to see this creeping into some of the higher frequency data by December of last year. But certainly there's an expectation that Q1 2021 will be a bit softer. The big important question for the South African economy, though, is not just can it recover in year-on-year terms, because last year was really bad and there was a 7% contraction, but is there real momentum in the economy? Can the recovery be sustained? And for the moment, this is uncertain.
Well, uncertain, I suppose, because we don't know exactly that. Is it just a bounce back to what we were? Or were the other factors that were slowing the economy beforehand, 2019, nothing to write home about, certainly not keeping pace with population growth? And this all goes back to perhaps the sort of other bigger number of last year, which is not included in this data, but it seems at one point last year we lost 2 million jobs on top of the 10 million people who were already unemployed. It would seem for the moment, unfortunately, it's unclear whether those 2 million jobs will come back or if they'll come back at the same level of income.
This is the big concern, and the uncertainty around the full reopening of the economy isn't just, are we going to see this continued boom because it comes just after a lockdown, but what is the overall economic condition going to be like? What are economic conditions going to be like? The uncertainty is how many firms will end up surviving. We know that the world over, regulators put in place measures that were more accommodative, meant to ease the channeling of credit, meant to keep businesses going, and those kind of policies can't necessarily be put in place indefinitely. But we also know that as we get the reopening of the economy, there's going to be some sort of reckoning. How many firms will have gone under on a more permanent basis? How quick is it going to be to try to get new momentum in place? What are the drivers of that going to be? Now, one of the positives of the GDP data was that we did seem to be seeing surprising strength in investment. That is important because it's one of the few components of the expenditure side of GDP that tells us anything about what the future might be like. If investment is picking up, as we did see in the fourth quarter, then the expectation is that maybe this feeds into actual growth momentum in the coming quarters. But for South Africa, this is the big uncertainty. And given that anecdotally, everyone expects it's going to be a very difficult jobs market still, we did already see the unemployment numbers rising from what we had seen as the lockdown lows last year when people weren't able to go out and actively look for jobs. The big concern is that you don't really get a sustained consumption boost for any length of time if people, a significant proportion of the population, have lost their jobs. We also can't ignore the inequality dimension of all of this. In South Africa, in many other emerging markets as well, it tends to be those at the lower end of the income scale who have been hardest hit. And that is where we've seen a significant loss, a significant erosion of jobs availability. This is something that policy is going to have to try to deal with.
Oh, Razia, trying to form economic policy. I mean, you know how difficult it's been to try and have a sort of radical change in our economy. I just want to talk a little bit more about this investment. I mean, we saw numbers out from Massmart. You'll know the consumer goods company yesterday. They talked about their building division. And in a way, running a company is like a household. If you're stuck in a house during a hard lockdown, well, at some point, someone in the family is going to come up with the idea of building an extra study or a place to work from home, or let's reorganize the stoop or whatever it is. And that's one of the reasons we've seen so many people spending so much money on small renovations that they can do themselves or with the help of their families. I would say that businesses maybe are the same. So a CEO has been looking at a lockdown, going into an empty office, going into and looking at sort of the accounts and thinking, well, what can I do over this time in the long-term planning to change my company for the better? Is it the same sort of dynamic? What that means, though, is a lot of that reorganization, unfortunately, ends up with fewer jobs.
So this is the uncertainty, and we've seen it play out, in a sense, on a global level. If we look at global trade flows, the fact that much of the world started working from home in 2020, this did create demand for new electronics. We did see some Asian tech exporters actually seeing booming exports as a result of all of that demand. But we already know on that basis that it's not something that is necessarily going to be sustained, even with the new second waves of COVID going forward. And I do apologize for the background noise. It's a bad time to be trimming the hedges in London. The big concern is that we are going to be seeing a very different operating environment as activity normalizes. And the question that needs to be asked then is not just what do you do to try to keep afloat, how do you keep conditions going, but is there really impetus? Is there going to be a signal to different businesses to say, actually, there could be a lot more growth momentum in the future? So it isn't just about preserving the market share that's been in place. It isn't just about business as usual and doing what anyone was doing pre-COVID, but it's going to be a great deal more around what are the signals that different businesses, that private sector investors are receiving that suggest they should be investing in anticipation of more accelerated future growth. And that's the uncertainty for the moment.
I mean, Razia, for the entire world, you get two big scenarios, both of them terrible science fiction. On the one side, the pessimistic side, it seems to me, you have the idea of a decade-long depression-style economy. Everybody talks about the 1930s, and they say it only ended with the Second World War. On the optimistic side, you have, well, after what happened in the First World War, the Spanish influenza pandemic around the world, which affected us very, very badly. Then you had a 1920s boom because the economy recalibrated. One of the big waves of globalization was in the 1920s. And I suppose the answer is that whatever happens, it won't be as either of those extremes. It'll be somewhere in the middle.
Well, the big expectation all along has been, compared to the 1930s, for example, policy was so much more proactive this time around. We've seen monetary easing across much of the world, very significant monetary easing in developed markets and some emerging markets. We've seen expansion of central bank balance sheets, central banks pumping unprecedented amounts of liquidity into their economies. And of course, the more recent theme, especially in the US, has been one of fiscal expansion as well. So this has given markets some degree of confidence overall that no, we're not going to be looking at a number of years of really, really weak growth. In fact, if anything, markets have been reacting in the recent past as though there can be, on the basis of the fiscal stimulus, on the basis of the monetary accommodation, a very quick bounce back in the future. The reality, though, is that there are still going to be risks. We know that for many emerging markets, it just hasn't been a choice to have policy as accommodative as was the case elsewhere. What economists are debating a great deal at the moment is what kind of inflation scenarios are we looking at a year out, 2 years out? We know that oil prices have gained very significantly in the recent past. Is this something that could damage the global recovery going forward? These are things that everyone is having to pay a great deal of attention to. And although the market seems to be making up its mind that, yes, for developed markets at least, it's clear there's a vaccination program in place, there is a recovery scenario, economies will be reopening, everyone will be bouncing back, it's optimistic, and policy has been so good at supporting this that it's giving weight, it's giving credibility to that growth story. Nonetheless, we shouldn't stop to look at the vulnerabilities of individual economies and what could potentially still go wrong with that recovery story.
Razia Khan, thanks very much indeed. Always appreciate the time. Chief Economist for Africa, Middle East at Standard Chartered. In a moment, we'll talk